financial argument. Follow us on YouTube.
We're going to have a discussion today about the economy and peak oil, how this is impacting our global finances and investments. And I brought on the line an entrepreneur, a hedge fund manager, expert on commodities. His name is ERIK TOWNSEND. He runs the podcast Macro Voices. His website is eriktownsend.com. ERIK, thanks for coming on the line with me today.
It's a pleasure. Thanks for having me.
ERIK, let's start off with the economy and just getting to know you. How much confidence do you have in the current situation that the rug isn't going to be ripped out from under the feet of what I've been calling a fragile economic scenario?
Oh, I think we have a very fragile economy, and I think it's almost a certainty that, things will roll over. If you look at cycle work that somebody like Robin Griffiths has done, usually what happens when you see the situation we have where there's a change of party and the other party takes the presidency after an 8-year term, as is the case now, usually the new president gets a 4 to 6 month kind of honeymoon period where everything appears to rally, and everything that the new president says they're going to do, people assume is really going to happen. And then reality sets in. So the thing that I'm really struggling with is it sure feels like reality is finally setting in, and the market is figuring out that just because Donald Trump says he wants to do a whole lot of things that would be good for the stock market, that doesn't mean it's actually going to happen, because it requires that the Congress actually agree with him. And there's probably no president that's been as opposed by Congress as Donald Trump is. So the thing that doesn't quite register for me, though, is it's a little bit early. If you look at the cycle work, there's normally 4 to 6 months after the new president takes office. That would be somewhere between, May and July. And here we are in March, and it's happening already. So is this the beginning of the market rolling over? It feels like it's not quite time yet, but I certainly think that it's coming by the end of the summer, if not now.
Is there a risk for Donald Trump's administration that the establishment is going to do what they can to potentially crash this on his watch intentionally? Is there something that they can do to make this happen, and do you believe that's a likely scenario?
Well, I don't necessarily believe that the intention of the people that oppose Donald Trump is specifically to try to crash the economy or crash the stock market to make Donald Trump look bad. But what we do know for sure, because they've said it very publicly, is that they're going to oppose anything and everything that Donald Trump does just because he's Donald Trump. And there's a shocking number of congressmen and their constituents who very much support if it's from Donald Trump, I oppose it on principle, even if it's good policy. So this is the only time I know of where you've had, certainly there have been times in the past when there were people in Congress who were trying to undermine the president's success. But I don't know of any other time in history when it has been the stated, publicly disclosed, no apology offered intention of at least half of the Congress to try to derail everything that the president does. It's really shocking. So I think that this has to end badly. I think that the assumptions that have existed as Donald Trump has described policies he wants to implement that would be good for the stock market, reduce taxes, all these things, he's not going to get any cooperation. And does that mean that the people who are not cooperating are trying to crash the market? I don't think so. I think they're just trying to crash Donald Trump. And that's, they're not showing any signs of letting up.
Well, Donald Trump is getting a lot of scrutiny about his pick for Secretary of State, Rex Tillerson. Obviously, heavy ties to ExxonMobil and oil. And I wanted to discuss this with you, given your research about oil. And do you believe that this is going to be the future, a necessity, given that we have this massive revolution going on in the clean energy sector, batteries, and many are saying that oil is going to go down to $20 a barrel that's its true price because of the new technologies that are coming out that are efficient and effective as they're getting more and more efficient and more effective. So just, what are your general thoughts? Maybe start off with Donald Trump's pick for Secretary of State and, the implications of that, and then move over to the latter half.
Okay, well, starting with Rex Tillerson as Secretary of State, I think that the presence of Tillerson in the cabinet and also, Harold Hamm is supposedly good friends with Donald Trump. What it really makes me think about is, will we see policy changes that are designed to promote American oil production over foreign production? For example, a import tax or duty of some kind on imported oil in order to make U.S. shale oil more attractive. If that were to happen, it would have a lot of consequences for the oil market. It would change a lot of things. But in the grand scheme of things, I don't think it really changes the global supply and demand. It's just a question of we get more oil locally. And I think that the risk that the good news probably is with these people on board, they should understand all these things. We really do need imported oil. Well, there's a lot of oil being produced in the United States, but it's light, sweet oil that our refineries in the United States are not set up to refine. So you actually have to mix heavy sour oil with that light, sweet oil, and that's imported heavy sour oil, in order to get to a grade that our U.S. refineries are capable of refining. Now, of course, that could change with time. If we were going to really focus on the U.S., maybe there would be, government money to, revolutionize or change the refining industry, build new refineries. And oddly enough, kind of ironically, it's not like you need a more fancy or complex refinery in order to refine the light, sweet stuff. It's actually the other way around. You need very complex equipment to handle the heavier oil, but that's what the U.S. is geared up to do. The easier, simpler style of refinery to design and build that you need for light sweet oil, we just don't happen to have that kind of refinery at this particular moment. So you could see a lot of changes to the landscape of whether or not the U.S. is importing oil or exporting oil. One of the things that's already happening is we're importing and exporting at the same time. Well, what the heck is going on there? Why would you be importing and exporting the same commodity at the same time? And the answer is we're exporting the light sweet stuff and we're importing the heavy sour stuff so that both we and our trading partners are able to mix them in order to get something that's refinable. Moving on to the second part of your question, I think a lot of people, it's a matter of time frame. Someday it's true that we will have a changed economy where you don't have as much reliance on oil. What people don't understand is this, what some people call the liquid fuels problem. And what that means is we are so completely dependent, everything in the economy, whether it's jet airplanes or ships at sea or cars or whatever, we need liquid fuel to run them. And even if, Tesla were able to achieve its goals and everybody has a Tesla, we don't have anything close to the electrical distribution grid capacity to run electric cars. So even if everybody had a Tesla, you would just cripple the electric grid. Now, that doesn't mean that the electric grid can't be upgraded so that eventually, many years down the road in the future, we do have much more use of electric vehicles. That reduces the demand for oil and so forth. When we get into peak cheap oil a little bit later on, though, I think you'll see that by the time that those things happen, we're going to be facing declines of conventional oil production that are going to prevent us from ever getting down to long-term $20 a barrel oil. Now, I think you could see a dip to $20, but it would be a temporary thing, and it would occur as a result of the shale revolution being restarted, especially if there was policy support from the Trump administration to help it get going. Right now, there's too much oil in the system. There's too much oil in the world. And this OPEC narrative about how they're supposedly going to rebalance the market is mostly rhetoric. It's the cuts that they're making are not nearly big enough to offset increases in production that have occurred in other countries and that will occur in the United States, especially especially if there's policy support. And it's a changing picture and a moving target. There's a lot of things that could happen in either direction. Venezuela is about to fall apart, potentially into civil war. If Venezuela were to go offline completely, that's a major loss of supply that would have to be compensated someplace else. But if Venezuela stays online and the U.S. shale industry really gets a boost with some kind of favored tax treatment where U.S. oil doesn't get taxed as much as imported foreign oil does, that could potentially change things pretty dramatically in terms of encouraging more supply. And more supply, of course, is going to push the global price down because we don't have the consumption behind it. If you add to that a recession, which, regardless of whether you and I are right to think that we're maybe teetering on the edge of a recession right now, let's suppose that we're wrong and there's no recession for the next year. Okay, look, we're way long in the tooth on the economic cycle. It's time for a recession. It's past time for a recession. So it's coming sooner or later, and when it does, if at the same time there's policy support for increased oil production in the United States, we're going to have a supply glut problem. It could easily create a temporary $20 per barrel situation, but I don't think it would be a sustainable long-term $20 a barrel. I think it would be an anomaly that would occur for a short period.
Eric, let's go down then the history, if you would, brief history of oil production and peak oil and where we're headed with the production globally.
Okay. Well, way back in 1956 or 57, I can't remember which it was, there was a geologist at Shell Oil called King Hubbard, and he predicted that the analysis that he did, he said, look, if you look at any oil field or any collection of oil fields, what happens when you discover these things and you start drilling them is at first there's an increase in production. You drill more holes in the ground, you're running more pumps, more wells, you're producing more and more and more oil. Eventually, the reservoir pressure starts to be affected because you're pulling so much oil out of the ground, there's less pressure there. And you see a peak in production, and then there's a decline. And the more oil that you take out, eventually reservoir pressures get to the point where you can't just pump the oil out. You have to resort to these new techniques, and they're actually not that new, but they're recently economic techniques such as hydraulic fracturing, which breaks up shale rock and allows the oil to flow out of it more easily. So any oil field or collection of oil fields, or the whole world for that matter, it follows this form where you discover a certain amount of oil, you start to produce it, and it increases in production, it hits a peak, and it starts to decline. And what Hubbard predicted all the way back in 1957 was that sometime around the early 1970s, roughly 1970, U.S. domestic oil production would peak and begin to decline. And then he also predicted back in 1957 that around 2000, world oil production would peak and begin to decline. And these two predictions were just remarkably prescient because it's exactly what happened if you only talk about the kinds of oil wells that existed back in Hubbard's time. So if you talk about conventional oil production, where you drill a hole in the ground and you pump oil out of that hole and you don't do any of these other fancy tricks like hydraulic fracturing, that conventional oil production on land or in shallow water, not counting, deep water offshore, any of the oil sands or any of the other non-conventional technologies, the U.S. peaked in the early 70s, and global production peaked in 2005, exactly like Hubbard said. And what the prediction is by about 2030, those conventional producing oil assets around the world are going to be in deep decline, and we will have far less oil, potentially, half as much oil production from those conventional resources as we used to. So that would mean a really, really big problem for the world. Now, the peak oil thesis, as it was originally conceived, was a little bit alarmist, and it was like, okay, so we're headed for this dystopian future where we're going to not run out, but we will be able to produce oil at a much decreased pace. There's not going to be enough oil to meet demand. We are unable to run the economy that has, when oil was discovered, there was only a couple of billion people on this planet. Now we're expecting by 2030 to get to around 8.5 to 9 billion people on the planet. You can't feed them all without mechanized farming equipment. You have to have oil in order to, keep the human beings alive on the planet. And the original peak oil thesis was, boy, we're in big trouble. Now, I don't buy into that version of the peak oil thesis. I describe what I call peak cheap oil. And the idea is, look, we're not going to run out of oil. There's no limit to human ingenuity. Just look at some of the things that we're doing with deep water offshore oil drilling, polar oil exploration underneath the Arctic ice cap. There's a huge amount of oil there. There's a huge amount of oil in the deep oceans that have never even been discovered. You know that there's going to be more oil, and we're going to find a way to discover it and produce it. But here's the thing. The days of just drill a hole in the ground on dry land and oil comes gushing out and it costs $10 a barrel or less to produce it, those days are over. All of the cheap, easy-to-produce oil, which is on dry land, you just have to drill a hole in the ground and you get oil out, that's over and done with. We've discovered all that there is. And what we're doing now is we're going back to oil wells and oil fields that were abandoned 50 years ago because they weren't productive, and we're installing much more sophisticated technology, hydraulic fracturing, horizontal drilling, and so forth, that makes it possible to produce oil from what were previously thought to be uneconomic resources. And the point is, you need higher oil prices in order to do those things. So we're not going to run out of oil, but we're in a era of history now where oil is going to become more and more expensive over time because it's going to cost more and more to produce and develop it, because it's going to come from more and more exotic places. We're not going to find more giant Saudi Arabia-sized oil fields on dry land. They're all gone. So we've got to do much more expensive things, and that means that energy will become a much more expensive part of the economy. Now, some people say, but wait a minute, doesn't electric vehicles offset all of this and change everything? It really doesn't. First of all, the energy that you deliver with electricity is like a delivery mechanism. It's like the pipe as opposed to the energy source. Where does that energy come from? Some of it comes from nuclear power production, and that does indeed offer the potential to replace oil with another power source. But if you're running electrical generation on natural gas or even oil itself, that's coming from oil wells. So that energy that you're delivering to the electric vehicle still creates demand for oil and natural gas, which is a related product to oil, unless it is nuclear generated. And of course, nuclear is very controversial, and a lot of countries are trying to phase out nuclear power. So, it's not just an automatic replacement. So the whole theory is not that we run out of oil. There's no cataclysmic crisis that ends the world, but energy will become a more and more expensive component of the economy, and we'll have to focus more and more on efficiency in order to better use the resources that we have.
Yeah, wow, this is incredibly fascinating. ERIK, let's talk a little bit about fracking. I know there's a lot of controversy about that. What are your thoughts on it? Is it really a threat to the environment the way we're hearing? And in general, what do you think? Is this good? Is this the future for us at least tapping into this oil that is otherwise been left abandoned?
Well, it's a tough one. First of all, fracking is a very effective technology to get oil out of rock that you couldn't have gotten oil out of before. The thing that frustrates the heck out of me on this, and it's not just this, it's also, something like global warming. The so-called scientists on both sides of the debate have been caught lying several times. We know we can't trust them. So if you talk to the oil industry, the answer is that fracking is occurring, thousands of feet below the water table. It is not related in any way, shape, or form to, anything going wrong with your water supply. That's all a bunch of nonsense that a bunch of crackpot environmentalists came up with that has no basis in fact. Then you talk to the environmentalists, and there are degreed scientists on their side that are saying, no, that's not true. There's actually, proven connections that fracking has increased the frequency of earthquakes in some regions, and that even though the fracking is occurring much lower, there still can be a result in the water table, which is thousands of feet above it. If that, I don't know the exact explanation of why. I look at it as, unfortunately, I don't trust the sources on either side. Everybody is biased. The environmentalists are willing to fabricate stories in order to support a cause that they believe in, and definitely the oil companies are willing to lie in order to protect their financial interest. So I don't really know. I would say that the people, especially Hollywood people that are making a big deal about fracking, probably don't know what they're talking about. Doesn't mean that they're wrong. It just means that I think they're working more on emotion and rhetoric than informed facts. As far as I can tell, fracking doesn't pose any huge risk the way some people say, but there is a connection between fracking and earthquakes. It's hard to say.
Sure. Well, all good points there. I guess my last question is where's the opportunity in this? Where's the opportunity in peak oil or peak cheap oil, as you put it?
Well, we are seeing, and one of the things that I want to stress is the view that I have about peak cheap oil. Some people would say, well, look at the last couple of years, this huge sell-off in oil prices. Doesn't that disprove the theory? And the answer is no, it doesn't disprove the theory at all, because if you look at the projected decline rate of producing conventional oil fields, that's all happened, exactly as everyone predicted. The shale revolution is amazing in terms of what it's delivering, but these are short-lived plays. Shale oil wells have a huge, huge steep decline curve. In other words, you drill the shale well, it's producing 1,000 barrels a day the day you drill it. A year later, it's producing 10% of that. So the decline rate and the need to invest more capital in those shale wells is dramatic. What's happened is, in the wake of the financial crisis, we've had just a sea of easy money, and a lot of it found its way into the junk bond market to finance just this huge malinvestment, too much investment in the shale patch, and it's allowing us in the short run to produce a bunch of oil, which frankly we're going to need a lot more later than we need it right now. But there's an opportunity for people to make a profit producing it right now, so they're doing it. And I think that what's going to happen in terms of opportunity is we're going to see a bottom in oil prices. Was the $26 that we saw last year, was that it? Or is there still another low coming? I don't know. I think there is a possibility that there's another low coming, because frankly, this OPEC narrative about how the market's about to rebalance itself is nonsense. If you look at the actual data, we are at an all-time record high of oil in storage. Cushing, Oklahoma is at 88.15% of its total capacity. So we've only got about 11 and point something percent, less than 12% of the capacity is available. If we run out of capacity there, which is where the West Texas Intermediate Crude Oil Futures contract is settled, there is takeaway capability to pipeline it down to the Gulf Coast, and there's more storage available there. But even that storage is filling up very rapidly. So we've got a situation where we may see another low, I'm not sure, but sometime in either last year or next year, I'm not sure which one, that epic low in oil prices is going to be something that's remembered for generations, because it's going to be all uphill from there. I don't know if the bottom is in yet, but I would say within the next 4 to 5 years, this situation has to resolve itself, and you're going to see much, much higher oil prices because of peak cheap oil. That's only after we kind of deplete. What we're doing right now is a lot of capital was made available to rush and produce all the shale oil in the United States sooner than we needed it. And we're going to miss it when we really need it. 10 years from now, it's not going to be there. It will all have been produced. So the opportunity is to understand that the bad news for the energy sector may not be over yet, but it's getting close. And when it is over, it's going to be the buying opportunity of a lifetime.
Well, Eric, you brought up many great points and a lot of things to look forward to. in many ways, good or bad, but a lot of changes nonetheless. So if people want to learn more about you, where would they go and what would they find?
Well, the best thing for people, especially more sophisticated investors, is I do produce a weekly podcast called Macro Voices. You can find that at macrovoices.com. And what we try to do is focus on finance professionals and very sophisticated retail investors. So it's not about, teaching people the difference between stocks and bonds. It's more looking at very advanced topics like, spread trading in the crude oil futures market or that kind of thing. So we talk to a lot of macroeconomic experts every week, and that's at macrovoices.com. Aside from that, I have a personal website at eriktownsend.com, ERIK, and I think there's a couple of videos there about peak oil and peak cheap oil. And that's about it.